Lesson 4: Accounting Principles. In the previous lesson, we saw some accounting assumptions that accountants make while preparing financial statements. In this lesson, I'm going to cover a few principles which are important for you to understand because these are the underlying principles on which financial statements are prepared. So before you start reading financial statements, you need to understand the principles based on which these are actually prepared. The first principle is called the accounting entity principle. This principle states that the business is separate from that of its owner. So in Joe's furniture factory, assume that Joe draws salary on a monthly basis. Though it's an income from Joe's perspective because he's receiving the salary, it is accounted as a cost or an expense in the books of the entity. So as far as the entity is concerned, it is a cost. So the accounting entity principle states that the business and the owners are separate and all accounting should be done from the entity's perspective and not from the owner's perspective. The next principle is called the measurement principle. A very simple principle, and it states that only transactions that can be measured or transactions that are quantifiable are recorded in the entity's accounts. And therefore, things which cannot be measured, like for example, the employee's loyalty, the brand value, the qualitative aspects are therefore not recorded in the books of accounts. So this is the measurement principle. The next principle is called the historical cost principle. As the name itself suggests, under the historical cost principle, all expenses and assets are recorded at the original cost when it was actually purchased, and no adjustment is made for inflation or change in market value. So assume that I bought a car long back, 20 years back, let's say at $15,000. As far as the books of accounts is concerned, this car will be showed at $15,000 only, less depreciation, and not at its today's market value. So theoretically, a building having a market value of $50 million can still be shown in the accounts at its original cost of $500,000. The reason for this is very simple, because accountants are lazy and there is no need to revalue the assets all the time or whenever there is increase in the market value. So the historical cost principle is very important because this means that when you read a balance sheet, what the numbers that you see on the balance sheet may have a different value in reality than what it is shown in the books of accounts. And again, it is very important to go through the accounting principles in the notes of account which are attached to the balance sheet, because some companies may not follow the historical cost principle. Some companies may follow the fair value method or the market value method, which is required under IFRS. That's a deep subject. We'll get into that at a later point in time. But it is essential for you to read the notes of accounts. So if you're an investor, if you're trying to understand the performance of a stock, please go and read the notes of accounts and accounting policies of the company to get a holistic understanding of how the business is performing. Next, materiality principle. This principle states that accountants account for only those items that have a significant impact on the business. So therefore, accountants won't bother if they lost, let's say, a small amount, 50 cents, since it has no impact on the business. However, it's very important because materiality is highly relative. What is material for you may not be material for me. And similarly, a transaction of $1,000 might be material for a small pizza shop, but may be highly insignificant for something like Apple Computers or Microsoft. So materiality principle states that accountants account for only those items which have a significant impact on the business. Next principle is called conservatism. Conservatism states that all expenses and costs are accounted for as and when they are anticipated. On the other hand, gains and profits are accounted only when they are actually received. So let me give you an example. So let's assume that you are likely to make a loss in a transaction. Under the conservatism principle, your books of accounts are supposed to account for it whenever the likelihood of loss is being established. On the other hand, if let's say you've made a gain and you're likely to receive those profits 2 months down the line, Again, under the conservatism principle, these gains are not accounted, and they're accounted only when they are actually received. So, a very simple summary. We saw 5 important accounting principles: the accounting entity principle, the measurement principle, the historical cost principle, the materiality principle, and the conservatism principle.